was so hawkish this whole week. Like there were statements.
That's
like
a messaging. That's a messaging thing. You can't base it off of their messaging.
No, I know.
You see Michael Saylor's tweet this morning?
Oh my God.
It's 3 words. Printer is coming.
I don't usually like to agree with him, but he's got a point. He's got a point. And this is all like what should happen, but trying to say that the central bank should do something is probably one of the dumbest things you can do, and betting money on it. So we're not going to do that. We're not going to bet money on something stupid like that. But it is possible. I'm just going to say that right now. It is possible. It might be kind of wild. Yeah, this is going to be very interesting. Extremely interesting. Yeah, get ready, because it's going to get, I think it could get way worse. I mean, it depends. It just depends. We're not central bankers, so it's really hard to comment like what we would do. But we're not central bankers. Our opinions are not important.
Yeah, but because other countries rely so much on the U.S. dollar, you think that we would have to intervene to not put every other country?
Yes, intervention at this point is necessary. The Bank of England has no more money. They basically used all their money to buy the 30-year gilt, and they already have so much gilt on their balance sheets, and it's going down in value. So all that QE that they didn't unload those bonds. Those bonds are still in their portfolio, and it's going down. And so they don't have any more foreign reserves anymore. So what do they have to do? The only way they can get more money is to print more money. And look at where the British pound is right now. If that happens, their inflation is going to skyrocket. It's going to skyrocket.
Hyperinflation's coming.
So they're actually in a really bad spot where everything they do can actually spiral out of control. It could be a very vicious cycle for them. And actually, China is pretty close to having that happen.
I was going to ask, but the only thing with China is, like, how much do we really know what's going on?
Oh, like, for example, Evergreen, all their debt is denominated in dollars. Now they owe 20-30% more because now the dollar's 20-30% higher. Why do you think the Chinese are so adamant about supporting their yuan right now?
Bro, I think that would be so, like, it would be bullish maybe at first for the stock market, but bro, the inflation's gonna go inflation's gonna tenfold.
And
it's gonna go through the roof.
And that's why I keep telling you guys, inflation is usually a 5 to 10 year problem. That's why I told you guys, get ready for a lost decade. And I now believe it more than ever. I think we're gonna get a lost decade pretty soon. This could get really bad. We'll see, though. We'll see. T minus 1 minute. We're going to start in 1 minute, guys. So... right, good morning, Checkmate crew. It is the opening bell of the New York Stock Exchange, 9:30 a.m. on this beautiful Thursday, September 29th morning, 2022. Yours truly, Mickey Blindside, here with your market memo. Okay, let's start. Let's start with the bad news. Okay, guys. So, as you guys know, I'm not one of those people that tries to sensationalize things. I hope that you guys trust me enough by now to know that I don't like sensationalism. I don't like, I don't like to fear monger, but there is some, I think, need for concern going forward. Okay. And this is what I see at the moment. Okay. So all of this is under the pretense that the dollar keeps going up. Now, if the dollar drops, some of this may get mitigated or it may get kicked down the road a little bit. But right now, I do see a chance that we might have some solvency issues. And I can't believe I'm going to say this, but I think the UK is on track to have that solvency issue. So usually this is an emerging market problem. But the UK right now is headed toward that. It's usually things that countries like Turkey, Sri Lanka, these kind of countries usually have solvency issues, okay? Not a mature economy like the United Kingdom. However, as I told you guys yesterday, they put 65 billion pounds sterling into the 30-year gilt. Basically, that is their bailout, a bailout of the longer maturity bonds. And so the reason why they did that was because they were pretty much margin calls. Pension companies, banks, large companies that invest in British bonds had to put up more capital because bonds, the gilt started selling off after the announcement of all those tax cuts. So in order to keep business as usual and in order to make sure that it didn't really go out of control, they had to put 65 billion pounds into the bond market. Now here's the problem. That's all the money they've got. I think 66 billion pounds sterling is the amount of their foreign reserves. So they pretty much used it all to buy more bonds. Now, during the QE era, after COVID and all that, the Bank of England still has a lot of bonds on their balance sheets. So guess what's happened to bonds? Guess what has happened to bonds for the last, let's say 6 to 9 months? They've all gone down. So not only is their balance sheet shrinking because they're losing value, they're pretty much losing money on the stuff that's on their balance sheet. Now they don't have any reserves. So what is their option? Pretty much they're going to have to print more money. Okay? Well, what happens when a country has already a lot of inflation and they print more money? Well, that's usually a sign that they're probably going to face a lot more inflation and they're probably going to have some type of solvency risk. All right, liquidity risk and solvency risk are a little bit different. Liquidity risk is when you can't pay now, but you can pay later. All right, you can't pay now, but you can pay later. Usually, liquidity crunch or liquidity crisis, we can get over that. Okay, back in 2020 during COVID, that's what we had. It was a liquidity crunch. All right, we got out of that relatively quickly. Solvency risks, solvency problems means you can't pay now and you can't pay later either. That is usually what leads to multi-year depressions in the global economy. All right, and I can't believe I'm saying this, but I think UK is already starting to show some of that. So if they can't print more, if they print more money, then the pound's going to keep going down, all right? And their portfolio of bonds is going to lose even more money. And this creates this vicious cycle that can cause the dollar to keep going up, all right? And as the dollar goes up, then other countries that have debt denominated in dollars, they're also going to suffer. I'm looking at you, China. China is on its way of having a solvency risk as well too. All those companies. Remember last year, Evergreen, that property developer? Well, guess what? All those companies, all those property developers, their bonds are denominated in, guess what? Dollars. All right. So if they're in dollars, these companies like these companies Evergreen, all that, their debt just went up by 20-30% just because of the dollar. Okay, because the dollar has gone up about 20-30% for this year, or for the last, let's say, 2 years or so. Okay, so now their debt is more. So basically what the Fed is doing right now with all this tightening is they're exporting inflation. They're exporting inflation to East Asia, to UK, to the Eurozone. This is going to be a problem if the dollar keeps going up. Now, if the dollar just drops, okay, some of that gets mitigated, all right? Or if it doesn't drop, central banks may have to get together and do something about this, okay? So, but the thing is, here's the thing. You and I don't know what the central banks are going to do, okay? You and I cannot bet on what the central bank will do, okay? That's like the quickest way of losing money, all right? So what are we to do? We're going to have to probably sit and wait for a while just to see what happens, and for this dust to settle. Okay, there's probably going to be some increased volatility. There's probably going to be headline risks, on and on and on. Okay, now, there's not a lot of people alive today who have seen anything like this. Okay, I think we're headed toward unprecedented times. Back in November, December of 2021, I told you guys that we may be in for a lost decade. Go on my Twitter. Go in around like February, March, I wrote an extensive thread about lost decades back in the 70s and 80s. Okay, so this is something that I saw, but I didn't see this happening so soon. I thought maybe 2024 we might see this. And we talked about emerging market credit crisis. I was thinking maybe end of 2023, 2024. That's when we're gonna see it. We may see it a lot sooner. Okay, we may see this a lot sooner. So I just wanted to give you guys shed some light on what's going on out there. You're probably going to see more and more about this in the media. You're probably going to see more and more quote unquote Twitter gurus talking about this as well. Okay, but you heard it here first. I've been looking at the Bank of England and some of the data coming out of there, and it just doesn't look pretty right now. And right now also too, there's a lot of insurance being bought on the dollar, with the dollar rising. And so, that also puts some pressure on U.S. equity risks. So, overseas investors, since more and more of their money goes toward hedging for dollar risk, that's less money, there's less demand than for U.S. assets if it costs more to hedge on currency risks. So we may see some international investors pull out of U.S. assets because of this. So this, this may affect us at least in equity prices. Now, this solvency risk, again, like I said, the Fed is exporting inflation. This is not going to be a U.S. problem. Okay, the dollar going up is actually makes our imports cheaper. Okay, this is going to be mostly the rest of the world's problem. All right. I already told you, UK, China, East Asia. We're already seeing problems. In Sri Lanka, we talked about that last month or the month before. Pakistan, India. Now also, countries like Senegal and African countries are now also starting to feel that pressure of rising costs A lot of emerging market countries will have bond debt due that's denominated in dollars. Let's see what happens. Okay, did they buy enough dollars to cover that bond payment or not? If they haven't bought enough yet, then on every dip in the dollar, you're probably going to see buying happening on every dip in the dollar. Okay, so let's watch out for that. Let's see what happens to the dollar. Does the dollar dip get bought ferociously? That means emerging markets are not done buying all the dollars that they need to pay off that bond debt in 2023. It means they don't have it yet. That could pose some real serious problems to countries like the UK and China. All right, that could be a problem. And again, this is happening really quickly. Again, I thought this was going to happen 2023, 2024, but it looks like we are looking at something probably maybe even sooner, maybe sooner than that. Okay, we'll see. If the Fed pivots, and it does, and right now the bond market is actually pricing in that the Fed may pivot. Remember yesterday or the day before when TLT went up, and I said, why is it in the upper edge of its price structure? And I said, oh, maybe it's because of oil, maybe because of commodity prices going up. Now I don't think so. I think actually more and more the bond market may be pricing in higher inflation maybe in about a year or two, because they believe that the Fed will pivot and loosen financial conditions at some point to mitigate some of these problems. I don't know. All right, I don't know. We don't know what we don't know, but that may be a possibility of why TLT made such an outsized move a couple days ago. Okay? And again, the bond market tends to look forward. The bond market and bond traders and institutional bond investors, they tend to see this coming way sooner than everybody else. All right. Let's actually take a look here. So, all right. So we're going back to pricing in a 75 basis point rate hike in November. All right. Let's see what the bond market is pricing in currently. 75, then 50 in December, 25 in February, and then do we stay at 75? We do stay at 75. 75, 7, Remember how it wasn't until, remember like last week when we checked this, or beginning of this week, it wasn't until December where we saw the odds here match the 450, 475. Now we're seeing it in June. Oh no, is it July? Yeah, we're now seeing it in July. So now the market is pricing in, I guess, a rate cut, the possibility of a rate cut a little bit sooner. Now we're back into the summer, a summer rate cut. Okay. And probably it's because bond investors think that the Fed will have to intervene on this possible solvency risk. Very interesting. Okay. This is something that, it takes weeks and months to really play out. So I just want you guys to think about this. This should be always in the back of your mind as you think about your long-term plans for trading and for investing. Okay. So keep that in mind, guys. Again, I think patience pays, okay? I think it's going to pay off to really be patient here. There's really no rush, okay? You really shouldn't be rushed to do anything at this moment. I'm mostly in cash myself. Even with all those shares of UUUU and HUT and everything that I bought, I'm still relatively very, very heavy in cash, okay? Most is cash, like 80, 90% cash right now, all right? I am not eager. And that's my speculative account. I never sell my SPY shares, never. I'll just keep selling premium and hedging and acquiring more shares. But as far as my speculative account is concerned, I am about 80, 90% still in cash at the moment, okay? So we'll see. We'll see what happens, okay? Are we going back to new lows? Yep, we're going back to new lows. Look at that. ES going back to new lows. All right. That was very short-lived. ZF bounced and is coming back down. This is not really, today's candle is not really much of a signal. If we start breaking down though below yesterday's low, so if this actually goes all the way down to like 106, 172, if we go way lower than that, that would definitely be quantitatively pretty bad for the for risk assets. Okay, so keep this on your radar. It's not as important as it was just yesterday. I think now really all back to all eyes on the dollar and all eyes on different currencies. EURUSD, let's just see what's going on. EURUSD, it is flat. Oh wow, look at that. What a hammer that is. And the British pound. British pound is up today, okay? It's up today. We'll see. One day, day to day, it's not important. It's the long weekly trends. And we are definitely on a downtrend, okay? Let's see what happens. Maybe the market is trying to price in some type of Fed intervention. Again, you and I, though, I mean, if you're smart, well, at least for me, I think it's smart not to bet money on what the central bank is going to do. Again, that is like the quickest way of losing your portfolio. So let's take a look. All right, let's take a look. Oh, I see one of you saying fade every pop. Okay. Well, here's the thing. So when you posted that, we were at 36.40. So we're still above that. Don't take just one day and think you're you're right. I mean, this market can go bounce up and down really quickly. Again, I wouldn't be surprised if we still get a relief rally, even in light of all this. I can still see that, especially if the ZF keeps going up. That creates a condition where money market, different money markets are not as favorable. Okay, so in the short term, we may see a little bit of short covering. Again, we got a lot of in the money puts on SPX option chain. If the VIX goes down and the ZF goes up, and if we see the dollar coming down, we could see this recover. You know, and let's just take a look at the long-term view here, or at least the daily chart. So yeah, I mean, we're basically where we started yesterday, where we opened, at least on the futures market. So I don't think, you know, it's all about closing prices. Okay, let's see what happens at closing. All right, it's all about closing. So let's. I'm not gonna do anything until closing today. Just like yesterday, I'm just gonna walk away from my screen, and we'll see what happens at closing, and then I'll reassess what is going on. Okay. So that's what I have for S&P 500. That's what I have for global markets for today. Nothing really. Let's just go over our positions. UUUU, I'm still in it. Still in those short calls and protective puts that I got almost for free. This collar, which I did for 3 cents of debit, which is, you know, practically free. It's nice. It's working well. I'm going to keep this open. So this, I think I'm pretty happy with that trade. We'll see what happens. Yesterday I also said too, we have a good chance of, you know, if you're going to play long, you may want to play Boeing. I'm not going to get long on anything. Again, my big trade is to short. All right. I'm going to short the market when we get to our levels. All right. I want to get to here, 41.25. If again, I don't know if it's going to get to here. We may just keep selling off. Who knows? Nobody knows, right? You can't tell the future. I can't tell the future. Nobody can tell the future. But if it gets to this level right here, 41.25, that is very compelling. I will still short the market right here. Okay? I got no problem shorting the market with size right here. I'm going to buy some put spreads right here. All right? And we'll see what happens. Okay? Let's look at some of our other indicators before we head over to crypto. The 2-year, 5-year, all are coming back up. We're seeing spreads. The spreads also, the 30, 10 and the 10 and 2, they all made some upward moves, but also another thing that I noticed, in the bond market, that the VIX of treasuries, the bond VIX, it's not treasury VIX, but it's the bond VIX. The bond VIX is still going up. Okay, and generally when the bond VIX goes up, we see also equity VIX, the S&P 500 VIX, go up as well too, or stay elevated. So this is very interesting right here. When bond yields are very volatile, it gets rid of the institutional bid. Institutions find it very difficult to price equities when interest rates are moving so much. All right, because they use discounted cash flow models. They use different different multiples based on where interest rates are. And so if they can't price cash flow assets effectively because they don't know what interest rate to use, then it becomes like a paralysis for them. They won't bid as much. So we'll see what happens. All right, but this is telling me that some more volatility is ahead, at least in the short term. Okay, at least in the short term. Oh, by the way, from our indicators, last night, the junk bonds ADL, even though HYG went up like 1.8%, our advanced decline line on junk bonds only went up by plus 82. If you look at the last few days, we were minus 813, minus 853, minus 1000, minus 668, and then yesterday 82. That's a really weak advance. Okay, really, really weak. I thought we were going to see a much bigger advance with HYG making almost a 2% move, which is a monster move on the HYG ETF. That's not the case. It was just you pretty much flat. Okay, so our underlying data is not improving at all. At all, it is not improving at all. New York high-low line is still going down and going down. It's still accelerating to the downside. Let's actually take a look and see intraday what's going on. So here, look at that. The high low is actually worse than yesterday at the beginning of at the opening of the market. It's worse than yesterday. Okay. We'll see if it recovers or not. We'll see. I can't tell the future. I think it's better just to stay out. Okay, and a lot of the more sensible pros that I know, they've all been sitting out for the last couple of weeks, some even couple of months. Most of the pros are staying out, and probably so because the reward to risk is just not in your favor to do these big trades right now. I know a lot of you love to day trade and do all of that, but just stay cautious. I think either direction, whether you buy calls or puts, I think it's very easy to get rug pulled either way at this moment. All right. So I'm going to be staying out until we get the right levels where our reward to risk is just stacked in our favor. And again, the trade in U.S. equities, at least, the big trade that I'm looking for is to short, because in the end, the long-term trend right now is down. And I want to short here at these levels where our reward to risk is just stacked in our favor. We know when we're wrong. If we're wrong, we just get out, okay, with a very small loss. So I would rather do a trade where I know if I'm wrong, it won't be expensive. Because right now, whatever trade you do, whether you're short or long, the reward to risk is such that if you're wrong, it's going to be very expensive. Okay, and as traders, our number one rule is to protect capital. So I don't want to be caught on the wrong side of a trade and pay heavily for that mistake. I would rather keep my cost of a mistake as low as possible, and in order for us to do that, that means we have to stay patient. Okay. Right now, only your little home gamers are being very, very active in the market right now. Most big institutions that are more longer term focused, they're not trading this right now. Okay. Of course you are welcome to do what you want to do, of course. Okay. Here, when we get here, again, I'm going to buy those IWM puts. All right. And I still have those short puts for October expiration. They're a little bit under. The strike is at 366. I got paid 1090 for it, so my break even is around 355. So I guess I'm a little bit up, but we'll see. I would like to take assignment. I don't mind taking assignment, and I'll just add it to my long-term portfolio, and I'll sell covered calls on them very aggressively. It's part of my long-term plan. But most of my buying, again, I'm going to wait for that 340 or so, okay? That 345 level. So that part still hasn't changed in my plan, all right? So yeah, so move index still going up. Because we're in uranium, I think it's a good idea to take a look at Australian dollar. Actually, let's just take a look at what's going on with China. Wow, look at that. See, so yeah, so they're having that issue too in China. All right. How is the Eurozone stocks? We already went over the problems in China earlier, just now, you know, as we started this. Let's take a look at FEZ. Yes, this one. Wow, look at that. So Eurozone not doing very well. Okay. I think so. I think the market is catching on that there is definitely a solvency risk, and you're probably going to hear the Twitter gurus and the media start talking about it maybe within a couple of weeks. Generally, the data shows it first, and then the media catches on a couple weeks later when it's already too late. So you guys heard it here first, so remember that. But yeah, that's what I see so far. If you guys are going to be playing... oh, this is coming back down. So if you guys, this is partially why, if I'm going to go short on the market, you know, this is our growth to value chart. I want to use either QQQ or IWM. The reason why I'm leaning toward IWM when I buy puts is because the advanced decline is still going way down. So breadth, market participation, you know, more and more of the stocks are facing declines, and that's usually means small cap weakness. Okay. So that's why I'm favoring IWM puts when we get to our 41.25 zone in the S&P 500 futures. Cryptos. Let's go over cryptos real quick. Cryptos, really nothing has changed all that much. We still have all that negative gamma here at the 1300 level. Right now, we're right at 1300 right now on Ethereum. Look at it, 1300. What did I say? Remember when I said when we have all that negative gamma, we might be chopping around that level for a bit? Lo and behold, we're right at 1300. Right at 1300, right there. We called it. We called it just a couple days ago as we saw this negative gamma right here. All right. So we'll see what happens. We'll see what happens. You know, it may chop around here for a bit more. We'll see. Okay. Maybe until expiration, and maybe after expiration, maybe then we'll see a big move in ETH. And again, we bought at 1241.46 last week. I'm willing to buy more if ETH gets to our Ethereum gold mine. Let me pull that chart up right here. Oh, we're getting closer to it. So this is where the big buy levels are for me, when Ethereum gold gets to this price right here, around 0.55 or so. Okay. So we're still seeing that options positioning. Okay. Let's see what happens. I don't see any big changes in open interest. At least I didn't see any when I checked right before I started the morning memo. Let's actually take a look and see if there's any big changes in open interest. Nominal value here. Nope. No big changes. No big changes. Let's see if there's any block trades that happened. Remember we saw those block trades in March 2023? Oh, look at this, June. We got some Junes now. We have some spreads. That looks like it's a calendar spread right here. A calendar combo? No, not a combo. This is a calendar spread right here. So they're selling the Decembers and using that premium to pay for part of June 2023 1,000 puts. So they sell the December. So it's a mildly bearish positioning. So maybe that's a hedge. I'm not sure, but that's a pretty big trade. Well, decent. It's a decent trade. It's a decently sized trade. Let's see here. Oh, that's another spread right here. That is that's a strangle right here, or straddle. That's a straddle right here. So betting on higher volatility in October. By October, we see higher volatility. So that's about $500,000 in premium right there. Somebody is betting about $500,000 of excess volatility coming into the ETH market before October 14th, 2022. That's quite a bet, all right? And then also, too, they sold the December 1,000 puts for the June 2023 1,000 puts. So mildly bearish, and then big move, so bet on a big move by October. Okay, interesting. We shall see what happens. I only legged in very little bit on ETH. And I'm glad I kept it small, so we'll see. And again, if we see that volatility to the upside, well, you know, oh well, we got a very small position. We made a little bit of money, so be it. I would like to see it sell off. Even though I'm holding just a little bit, I would like to see it sell off and get here. That would be a major buy level for me. Okay, so nothing has changed, but it does look like we're seeing some trading, some longer dated trading happening in December of 2022, June of 2023, and then also for October, which is not that far away. That's only that's 2 weeks away. So somebody's betting on some volatility in the next 2 weeks. The CPI report comes out then around that time too. I believe it's the 13th when it comes out. So you know, if the CPI comes out good, I'm sure, you know, the markets will have a huge sigh of relief. If it comes out worse than expected, well, maybe we can expect 3,300. And again, we're not trying to predict the future here, but we did anticipate that it may be a possibility, especially with the options market positioning that we're in, that we may see an undercut and see it actually hit that 3,400 zone sometime in the next month or two. All right, we may see that. Okay. And right now, there's a lot of puts that were bought here. A lot of puts got rolled down, and so we're actually seeing some put walls here. So if we do see it undercut, you know, that may be the first place where put holders cash in their puts. So we might see a little bit of a relief rally after a first touch around these levels. Okay. Again, I'm not sure if it's going to get there even. I'm not trying to predict the future. I'm just anticipating what could happen just based on the data that we're looking at. All right. Anything else you guys want to look at? Any questions, concerns? Any rude remarks you guys want to make? Going once, going twice. All right then, sold. All right, we're going to end the market memo. If you're joining us on Twitch, YouTube, or Facebook, check out the video description below. We have links to all of our sites and our Discord channel where we talk trade around the clock. We talked about a lot of this solvency risk earlier in the morning in the wee hours And so, it's all free. There's no paywall, so you might as well join. What's the risk? What do you have to lose? Go ahead and click on that Discord invite link and come join us. We're all about educating and building a thriving community of traders where we can bounce ideas off of each other. It's of the people, by the people, for the people. All right. I am going to try and stick around in the Discord today. I'm just going to turn off my terminal and walk away from my screen. I'll just hang out in Discord for a bit if you guys have any questions. And tomorrow I will try to do another live session as well. I'm going to try to do one at the end of the day. We'll look at some monthly charts because it is the end of the month tomorrow. And I think it's a very appropriate time for us to look at some of these longer term charts and look at some of the monthly options expirations on SPX. And I'll let you guys know when I do that tomorrow. So stay safe, and I'll see you guys tomorrow.